Good morning, good afternoon, good evening, folks. It is Wednesday, and you know what that means. Yes, we bring on your favorite expert. This is Anna Kelly, REI mom. How you doing?
I'm doing great. Always so good to be here.
All right. Well, I forgot to ask up front, so I'll ask you on video. How was it dropping off your oldest son at college?
Well, it was, I walked out the door bawling, crying like this can't really be. We hugged him, we prayed with him, we told him how much we loved him and not to forget us, and then we had 2 days of driving to get to Florida.
Yeah,
So
yeah.
we had lots of great time in the car. Dropped him off. It was a little scary, Michael, because we dropped him off with a hurricane, a
Oh,
major hurricane, hitting Louisiana, but with the outer bands in Florida.
oh yeah.
And
Okay.
we left at 3 Saturday, and they had a hurricane warning and lockdown by 7. So we're driving away going, oh God, please keep my baby safe. But other than that, he had fun. He's having a great time. He loves being in Florida. He's already been to the beach. So I'm
Nice.
like, how good is that to be able to be in school and the beach at the same time?
Well,
So
that is awesome. It's going to be fun just to watch him come home. I remember when we dropped Teresa off seemingly a decade ago. Actually, wow, more than a decade ago now. That was a rough day, as I've shared. And then I remember her coming home the first time. Oh, it was so awesome. So I look
yes,
forward to that.
I can't wait. And he really enjoyed being on the show last week. So
Oh,
I
that's
need to
good.
go. Yes, I need to go find and re-listen to that episode, but he really enjoyed that. That made an impact on him. So thank you.
Oh, that's so awesome. I tried. I tried it, and he's a great kid. So he's going to do really well. So, hey, you know what? Something you and I did, I think a month ago, is you helped me review 50 years of housing data, wage data, interest rates, payments, all of that. You remember that conversation?
Oh, yes.
Awesome. So what I wanted to do now is I wanted to use that lens, use the averages over 50 years or 5 decades, and I'm going to try to predict 2029. You want to have some fun?
Oh, yeah.
Awesome. Let's
Oh,
try to predict 2029 together. So let me share. This is how I built my logic. I don't know if it's right, but this is how I got there. So let me make this a little bit bigger.
this could be worth millions, Michael. I've been trying to figure this out myself, right? We
Yeah.
don't have a crystal ball, but we got a lot of information to try to predict. So
Yeah.
I
So
can't wait for this.
this is going to be fun. So was my logic, right? So I had to build it up. So the first thing you and I have talked about over the years is I believe we're going to have rising rates this decade, right? Right. I don't think we're going to go down from 3% to 1%. Could we go there in a brief period? Sure. But I think by the end of this decade, interest rates will be higher. That's my opinion. Is that where you're at as well?
Yes, absolutely.
So the first thing I had to ask is, okay, if rising rates and we're going to be higher in 2029 than we are in 2020, what happens to housing? Well, good news is that's happened to us before. In the 70s, we went from 8.5 to 11.2. And, lo and behold, that's a 30% move in the interest rate. But oh, by the way, look at housing. It was up 103%. So not bad. If you owned a house in 1970 and had a 30-year mortgage, you were doing pretty good by 1979, right?
Yes. Yeah,
And,
so true. Because with inflation, so rates usually go up with inflation, right?
Mhm.
With inflation, asset prices tend to go up.
Also, and rent goes up. Again, if you were a landlord in 1970, you were very happy by 1979,
Yes.
right? And then the other thing to realize is what you and I uncovered last time is a lot of housing has to do with wages. And as you will see, wages, again, this is family of four, was up almost 100, or let's call it 90%.
Wow.
So again, lots going on. And again, if I'm going to guess rents were higher in 79 than 70. I'm going to guess. Make sense?
1970s was the only decade with rising rates in the last 50 years.
Yep.
Wow.
Well, so we did have some years where they were up or down. This is 70, 79, 80, 89, 90,
Right.
99. Yeah.
Right. Awesome.
Okay. So that's the only time it happened. So what about wage growth? So again, if we're going to predict 2029, we've got to look at wages. So this is what wages did in a decade. They were up 88%, 63, 35, 25, and I don't know, call it 42%. Right? That makes sense what we're doing so far?
It does. And you know what's really interesting with this data? So people are saying wages have not kept up. Wages have not kept up, but wages have kept up.
Yeah. I mean, wages went from, I don't know. Yeah, they've got, they are clearly moving, right? That's clearly what this shows.
Yeah.
Okay. So then what happens? What would the median income be if and only if we use the average of those five numbers? That's what I did next. So again, I averaged those five numbers and it's basically 51%. So if we know the average and we know where we started, which we do because now we're in 2021. So I went back to 2020. This is the average family of four. You take that number times that number, you get this number. And then I know a lot of people are going to wig out and say, oh my God, nobody's going to make 100 grand a year. It's impossible. Folks, this is two incomes. So that boils down to $28.40 an hour for two full-time employees. So it's not unheard of. Certainly. And again, remember, 8 years from now, we're talking about.
Yes. And if you think about, 5% growth per year when there's inflation is not significant.
Yeah.
Number two, people on minimum wage in a lot of states are not that far, right now. There are workers all over the country. There are employers who are struggling to get people at $20 an hour because they make more on unemployment right now.
Right.
So, 28 from 20 isn't a significant jump. So I think this is actually very realistic.
Yeah. And again, it's the median, right? It's not the lowest band. 28. I'm not trying to say that $28 is going to be the minimum wage. That's not what this is. This is people that have been in their jobs a decade, 12 years, 15 years. Those folks should not be making minimum wage.
Right.
So yeah, I think when I looked at 118, I was like, oh my God, that can't happen. My what's wrong with my numbers? And then I remembered, well, that's mom and dad. And then you divide it by this, it's like $28. I'm like, that's possible. So I feel good about that. Okay. Yeah. All right. So then I'm like, okay, have wages ever outpaced housing? Right? Because does housing always exceed wages? Does wages exceed housing? I'm trying to figure out where my governors are in this idea. Lo and behold, the 90s. Housing only went up 27%, but wages went up 35.9%. Interesting. I didn't know that ever happened, but now I know.
Wow.
Yeah. One time in 5 decades that happened.
Wow.
Yep. So again, people are always saying wages aren't keeping up. Well, in the 90s, wages were exceeding housing. So, yeah. And again, remember, as you know, housing is a levered business. So, all right, you're not paying cash for housing. So, okay.
Right. Yeah, that's really interesting.
Okay, now for the big question. What could median house price be in 2029 using the same thing we did for wages, but now on price? So the average for income was 52. The average for a house is 56 and a half. The median in 2020 was 270. Same idea, do the math. We're at 423, call it 424. And again, this is 2020, not 2021. With this, because I think 2021 median is like 366. So what I've been saying, I believe even more that we've front loaded a lot of the appreciation. Right. It's going to plateau from here or go up very slightly. That's what I think this is what it's telling me.
I agree. Unless you've got an area, some of the places in the South, like we talked about, where there's a lot of people moving there, and the supply and the demand are going to be, undersupplied for several years. Maybe it goes up even more than this, but I think, across the board, it's 5.6% per year is not significant. Not significant
at all. All right. So now the big question, is housing going to be affordable in 2029? And the only variable we haven't talked about is interest rates. So what I did in this spreadsheet is I took it from 3 to 7, and then ultimately took it all the way out to 10. I forget what I added in here. I think I only did to 7 for visualization. But here we go. I took everything is the same price, same income. The down payment is 10%. So basically, I just moved the interest rate from 3 to 4 to 5 to 6 to 7. And lo and behold, right down here, payment percent of gross, that's obviously the front end ratio. And it's shocking to believe, but we're pretty affordable, even at 7% 30-year fixed rate money. Right? A front end ratio of 25% will get you a yes answer from a bank.
Yeah. Wow.
Pretty crazy, right?
When you look at, so the payment as a percentage to gross 25% at the 7% interest rate, how does that compare to each decade from before?
Doesn't have that. So I actually went back and looked at where 25%, it's 1992 is the closest number.
Okay. Yeah, that's what I was wondering.
Yeah. So again, 25% would be cheaper than, I think I did the math, 41 of the 50 years. So there are 9 years that are cheaper, meaning lower. Like 2020
Wow.
was the lowest. It was 16%.
Wow.
But there are 9 years that are more affordable than 7% interest on a 423. And again, it's the incomes. People are talking like incomes don't move. In this example, using 5 decades of information, wages are going to go up. I already forgot 51%. So it's pretty interesting to see that, you know what, we could have higher prices, just like the 70s. Prices doubled in the 70s and interest rates went up 30%.
Right.
You know, it's pretty
Right.
interesting.
It's very interesting. It makes you want to keep buying real estate.
Yeah.
Right?
With 30-year fixed rate debt.
Yes.
Yeah. Cause
Yes.
I go back to the 70s and I go, man, can I imagine doing a 30-year mortgage at 8.5%, which is what they started at? Well, I'm like, well, damn it. If the prices double by 1979 and rents go up 50%, heck yeah. It's
Yeah.
when you look at it in this context, it's like housing could still be remarkably affordable. Now, I did do the math out to 10%. You start getting no answers from Bake actually at 9, right? I took them. I had to break the spreadsheet because 7 was still a yes answer. It breaks at 9%. So if we go up from 3 to 9, it breaks.
Yeah. No, that's really interesting. I had done some numbers and I had seen some stats that were done on when is it wise to continue to fully leverage, like, go 80% LTV up to what interest rates that still make the leverage the right thing to do for the payment and your profitability. And 7% was the number. Like as long as interest rates are 7% at less as a real estate investor, 80% leverage will still get me the cash flow and the DSCR that I need to continue to move forward profitably before I start saying, I want to put, more down and have lower than 80% LTV. So that 7% is kind of looks like a magic number with what you're doing as well.
Yeah. That's interesting. So now I have to ask, can I imagine a world where the 30-year rate is 7% by 2029? And my crystal ball is as broken as everyone else, but I can't see it because of just all the other debt that's out there. I can't see 7. Can you?
Oh, goodness. I would say no, except that I think back that 7 and 8 wasn't that long ago.
Yeah, that's true. That's very true.
I mean, our first mortgage was at 8.75% with perfect credit.
That's right.
In 2000. Yeah. So I'm pretty sure it was 2000. So, it wasn't that long ago. Now that was kind of, teetering up at the top before the crash. But, I thought rates would really go up after the 2009 crash. And so I locked in and then I paid extra to lock in at prime again. And then prime dropped and I'm like, I'm stuck. And prime I never thought prime would go below 5. And then it was at 3.25 forever. Right. Yeah. So, and now we're at, even less. And so I think it's probably going to take a really long time before rates get above 5.
Yeah, me too. That's where I think this thing gets wonky is at 5. 5's my number.
Yeah. But it'll be interesting to say, I've been wrong before. Part of me thinks with
I'm wrong all the time. Just ask my wife.
Yeah. With inflation and the money printing, I think that rates could very well go up, but our debt is so high that they need rates to be somewhat low. To keep people buying. So they'll raise rates if things get overheated. They say this inflation's transitory. So they'll raise them a little bit, but I don't think they're going to raise them, 3%, 4%.
No. Yeah, I don't see it either.
I think it would break the economy. I do.
I think it would. Yeah. I mean, yeah. I think they get the Fed fund rates much above 1.5. And again, they're at 0 to 1/4 now. The thing starts cracking. Just all the other debt that's levered up in this, it gets interesting. So this is a lot of fun. I love looking at history, and now we just took a shot at the future. So how can people follow you, be part of your world?
Thanks, Michael. You can find me on Facebook, Instagram, LinkedIn at Anna REI Mom Kelly, and greaterpurposecapital.com for syndications in apartment investing with meaningful impact.
Very cool. Thank you very much, Anna.
Thanks, Michael.